we own quite a lot of differentiated, innovative growth businesses within the healthcare space. And I would say also we're not as overweight as we were, because some of these companies have done incredibly well and have met our price target, and we've actually sold some of these companies because they've just gotten too expensive for us. So our overweight now is not as much as it was. But the sort of companies that we own are things like Danaher in the biologic space. So these are the companies that are coming up with the new types of drug discovery and production of these drugs. They kind of enable drug companies to kind of put these new drugs into production. Companies like West, which is the global leader in manufacturing syringe plungers, which it's one of those things that it doesn't cost very much, but it's a critical element to pre-filled drugs in syringes, because if a drug gets contaminated with anything that's in the plunger, the whole thing gets ruined. And so it's actually a fantastic long-term growth company, which we own. And we own a major contact lens manufacturer called Cooper, which has done extremely well. And and maybe one other, Zoetis, which is the leading animal health drug manufacturer. So we're in certain niches. We tend not to own big drug companies as such, because they tend to be conglomerates. They have, some drugs doing well, some not doing so well, and of course they also get picked off by generics. So that we don't see them as particularly great businesses, whereas the sort of ones we own, as I say, are quite differentiated and long-term growth situations. So we still have quite a decent position in healthcare. We're not as overweight as we were, but we still think it's a good area to be. There's a lot of innovation in that sector, and we want to be there. The move to online, led by companies like Amazon, has really been quite detrimental to the physical retail sector. And if you think about consumer discretionary, it's dominated by that space, by retailers. And so we've not wanted to be in that area because we can see it being heavily disrupted. However, we like the online space. So e-commerce is an area that we are exposed to. Obviously, Amazon is the big player there, and we have exposure there. But also, a differentiated player like LVMH, which is one of the globally dominant luxury goods manufacturers, dominates. It has its own brand that's a long-standing brand, been around for over 100 years, is loved by women everywhere. These leather bags sold at very high margins, I might add. Very popular, particularly in Asia and some other emerging markets. But they also dominate the champagne region. They have by value about 80% of the output of all champagne comes from LVMH. So it has a great franchise, and so we have exposure there, but we're underweight simply because we're not in the retail space so much. The sort of companies we own are going to be companies that require very little capital to grow their business, more like the software style businesses. In other words, they don't require having to build big plants or create mines or whatever it is. People get together, they come up with some great innovative new ideas, and they're able to sell these ideas through the internet or whatever it is. Those kind of businesses do tend to be extremely cash generative, and so this is something we look for in our businesses. And one of the things we look for in our valuation metrics is a free cash flow yield on a prospective unlevered basis within our kind of short forecast period of around 4% or so, which is a pretty healthy cash flow yield, and it equates quite nicely to the free cash flow yield on the S&P, for instance, 500, which currently is around just under 4%. So we think we're owning the best elite businesses in the top 5% globally, but at a free cash flow yield of not that different to the market average.